So welcome back, friends. Now we are going to see different types of short-term decisions. We saw the types of decisions. Okay. And now we are moving to the first category. Write the heading: outsourcing decisions or make or buy decisions. Outsourcing or make or buy decisions. Outsourcing or make or buy decisions. Okay. Now, what do you mean by outsourcing or make or buy decisions? Suppose a company A Limited is manufacturing a particular product called A. Okay. Now, for manufacturing this particular A, it requires three components: component X, Y, and Z. Currently, all the three components X, Y, and Z are manufactured in the factory itself. Okay, it is in-house production. But manufacturing of all these three products requires the use of a special machine. Let us say machine P. And the availability of this machine is limited, due to which the company A Limited is not in a position to manufacture the maximum required quantities of X, Y, and Z. Okay, say for example, X they require 20,000, then Y they require say 40,000, and Z they require 10,000 units in the proportion of, for 1 unit of A 20 they require 2:4:1 proportion of X, Y, and Z. But they are not able to produce this entire quantity due to the lack of sufficient availability of this machine hours, the machine P. Okay, now due to which the production is not into the full capacity. Now the company is thinking of alternate options. One option could be, out of these three products X, Y, or Z, any product could be purchased from outside in the required quantity. So what is the use? If Z is purchased or purchased from outside, then X, the hours available with machine P can be used exclusively for X and Y, with which the company may be able to produce entire quantities of 20,000 and 40,000 quantities of X and Y respectively. Is it clear? This is one scenario when the company will be thinking of outsourcing or make or buy decisions. That is one point. Now, there could be another situation. Same company A Limited is manufacturing three products A, B, and C. The company will have its own cost and revenue information, due to which the profit per unit or contribution of A is, let us say, 10 per unit, and that of B is rupees 4 per unit. But in the case of C, it is -1 per unit. C is producing -1 contribution. Now, on analysis, the company came to a conclusion that if C is outsourced, that means if the manufacturing of C is outsourced, then C would be available at a lower cost than the manufacturing cost, due to which this negative contribution can be increased to positive contribution of 2. Okay, another scenario. Is it clear? So in all these situations, the management of a company or an entity will be required to take a decision whether a particular product or component or part should be either manufactured in-house or purchased or subcontracted from external party, from external party. So such decisions are known as outsourcing or make or buy decision. Okay, now to add on to this, let me tell you, as the general principle will be, if a product is manufactured internally, or let me use the term in-house, is manufactured in-house, the following benefits will be available. The following benefits will be available. Okay, what are the benefits? Benefit number 1, the cost of the product could be lower. Okay, because manufacturing cost is generally lower than purchase cost. Why is it so? Because when you purchase a product from the outside market, you need to give the margin to the seller also. So naturally, the seller will be charging a premium price from you. So in majority of the cases, if you know how to manufacture a product and you have the requirement for sufficient quantities of the product, always in most of the cases, the cost of manufacturing will be lower than the purchase price. Is it clear? So that would be one reason why everybody will be looking for manufacturing the key components or majority of the components in-house rather than purchasing it from outside. Cost savings. The second one, ensuring required quality. Okay, so suppose if a particular product is produced in-house, that company may be able to monitor that the products produced has got the sufficient quality. Okay, so there will not be any compromise in the quality. The company can produce the product with the required quality. Okay, so these are the major 2 reasons why entities prefer manufacturing components and parts in-house. Is it clear? Then second, factors in favor of outsourcing or subcontracting. Okay, but sometimes manufacturing a product in the factory may not be a good decision as far as the management perspective is concerned. It would be better to outsource or subcontract or purchase from outside, or at least evaluate the options or alternatives available for subcontracting. Now let us see what all are such situations in which an entity or management should think of outsourcing or subcontracting. 1, again, first point will be cost saving. What do you mean by cost saving? Same or identical product is available at a lower price, lower cost than the manufacturing cost. Okay, that means if you are going to manufacture, one unit will require say 25 rupees per unit, whereas if you are going to outsource it, due to economies of scale of production for the buyer or for the seller, you may be able to procure it at 22 rupees. Okay, if you buy things, components, parts in bulk from entities which are commonly concentrating on such manufacture itself, there may be cost savings also sometimes. Okay, so that could be one reason. Second reason could be what? Use of spare capacity. Use of spare capacity for producing high profitable product. High profitable product. This is another situation. Suppose I told you in the case of that machinery, okay, they are manufacturing 3 components and all the 3 components requires what? The use of a particular machinery. Okay, now similar situations may arise when the company is manufacturing more than one type of product for sale, and out of that all the 3 products may require some specified labor category of laborers, or the consumption of certain particular machinery, etc., etc., due to which the sufficient quantities of that machine hours or labor hours required to manufacture the entire demand of all the products may not be available. So the management may think of subcontracting those products which has got a lower profitability or margin and manufacturing the products which has got a high margin. Okay, this is something known as cross subsidizing. So even though the management is taking a big cost increase in the case of products with lower margin, this can be well compensated by manufacturing more quantities of the products with higher margin. Okay, so that is another case. Next, there may be situations of meeting extra demand for few products. A particular product has a huge demand which is not able to be met from the factory production itself. So what you can do, you can subcontract the manufacturing to another person, procure the manufactured goods from the subcontractor, then sell the product to this one. Basically a trading kind of thing, so that you will be able to meet the maximum demand. Okay, next, benefit from the suppliers efficiencies. What do you mean by suppliers efficiency? See, you are manufacturing car. Okay, you are manufacturing wonderful cars. But manufacturing a car requires what all things? You require a lot of parts. Like tire is required, engine is required, then upholstery works, seats and things are required, body parts are required. So many things are required. You may be an excellent in manufacturing car, but you may not be excellent in manufacturing a tire. Okay, if you, just because you want to manufacture a car, if you think that no, I need to manufacture all the components, so let me manufacture tire also, sometimes what will happen, the cost of manufacturing tire by your company or your firm will be far higher than the cost at which the same tire is sold in the outside market by other reputed companies. Okay, so sometimes your suppliers or the persons to whom you are subcontracting or outsourcing, they will be specialized in that particular component or in that particular product, due to which there will be economies of scale, due to which they will be able to produce the same product at a lower cost as compared to your product. Okay, that is, you want to benefit out of that, that is benefiting from the suppliers efficiencies. Okay, so these are the main reasons why we go for outsourcing decisions. Now, how to do the analysis? How to perform the analysis? Okay, we follow a method called incremental analysis. Incremental analysis. What do you mean by incremental analysis? In incremental analysis, you are computing 3 things. 1, incremental cost of manufacturing, of outsourcing, sorry. That means when you outsource the product, what is happening? You are incurring a higher cost, because if you are manufacturing, you would have been able to manufacture at a lower rate. Whereas when you outsource it, you may be required to pay a higher amount. So that difference between your manufacturing cost and your purchase cost is what is known as incremental cost of outsourcing. Okay, so what is this? This is the additional cost incurred for outsourcing or purchasing a product. Okay, then this is equal to cost of outsourcing minus cost of manufacturing. Okay, generally it is only relevant cost of manufacturing. Is it clear? Okay, cost of outsourcing minus cost of manufacturing. Now cost of outsourcing will be what? The purchase price plus you may have transportation charges plus inspection charges, inspection cost plus other ancillary cost. Is it clear? So that is cost of outsourcing. You find out what is the cost of outsourcing the product, you minus the cost of manufacturing. Generally cost of manufacturing will be relevant cost of manufacturing, which will involve what all things? Variable cost of manufacture. Then you have what is that? The second one would be specific fixed cost incurred. Specific fixed cost incurred. So that is incremental cost of outsourcing. Now next, incremental cost savings due to outsourcing. Okay, no, this is not required. Okay, you can write here incremental cost of outsourcing in bracket vis-a-vis cost of manufacture. Okay, now next is opportunity cost or gain on outsourcing. Okay, what do you mean by opportunity cost or gain on outsourcing? Suppose when you outsource certain product, there may be some spare capacity. It could be space, it could be machine hours, or it could be even labor hours. And this spare capacity could be used for manufacturing some other products, which may yield you a higher contribution or higher benefit. So that higher benefit which we are earning from additional the additional production using the spare capacity may be taken as a opportunity cost or opportunity gain of outsourcing. Okay, so opportunity gain due to manufacture of other products using spare capacity. Spare capacity could be machine hours, labor hours, etc. It could be anything. Now, there could be certain cases of opportunity cost also. Opportunity cost on outsourcing. What could be the opportunity cost? Suppose when you are manufacturing this particular product, if you are manufacturing this particular product in-house, then you require to purchase what? The materials for that. So the materials, when you are purchasing on bulk, that means the materials required for this product which is being manufactured and also other products, you may be eligible to get some discounts from the supplier. But since you are taking a decision with respect to a particular product to outsource it, you may lose such discounts, quantity discounts, which may act as an opportunity cost for you on account of outsourcing this particular product. Okay, so opportunity cost of outsourcing, generally it is discounts of cost discounts or benefits foregone. Due to outsourcing. Is it clear? Okay. Now, net cost of outsourcing. What is net cost of outsourcing? Incremental cost of outsourcing plus opportunity cost or gain. If it is gain, in negative. Okay. Now, decision making. Decision making. If net cost of outsourcing, is positive, what does it mean? So it is resulting in additional cost as compared to the manufacturer. So manufacture the product subject to other qualitative factors. Then if net cost of outsourcing is negative, outsource the product subject to other qualitative factors. What do you mean by other qualitative factors? See, this decision, that is incremental cost of outsourcing plus opportunity cost, that is purely from financial perspective. But when you take a decision for outsourcing a particular product, you have to consider financial perspective, but you should also consider non-financial perspectives. Okay, so such non-financial perspectives may also warrant you to take a decision with respect to outsourcing or manufacturing. So the conclusion says that you will have to take a decision based on this, but subject to the qualitative factors. Is it clear? Okay. Now, what you can do is, we have to do a problem. Okay, now before that, the effect of qualitative factors once more. qualitative factors to be considered. Which are the qualitative factors to be considered? Okay, one, the effect of quality of goods. Quality of goods. Then what else? Reliability of outsourcing entities. Reliability of outsourcing entities. Then impact of outsourcing decision on the laborers. Then impact of outsourcing decision on the suppliers or customers. Suppliers or customers. Is it clear? These are the qualitative factors to be considered. Any decision for outsourcing will affect the quality of the goods. So we have to consider that. To what impact the outsourcing decision will make on the quality of the goods. Then second, the reliability of the outsourcing entities have to be seen. If you are giving the outsourcing work to a local entity which is not bothered about the quality or reliability, there may be two problems. One, the product what you are receiving may be defective. Second thing, you may not receive the product on time. Okay. Now third, impact of outsourcing decision on the laborers. You may have to return the laborers because you are outsourcing some activity which initially you were manufacturing or you were doing on your own. So you had employees working for that particular activity which is no longer required once you took a decision for outsourcing. Okay, so the impact of outsourcing decision on the laborers have to be analyzed clearly, and also the impact of such a decision on the customers as well as the suppliers also have to be seen, because the customers may not happy, because customers may expect you to manufacture everything on your own. Okay, suppose you are getting a particular product car from Volvo. Now tomorrow Volvo says we are manufacturing most of our components from China, where we are not monitoring things. Then the suppliers, the customers will be little unhappy. Okay, so certain anything may happen on that. Okay, so these are the qualitative factors to be considered. Now let's move to one of the problem. You can take question number 6.16. 6.16. No, it is page 6.16 illustration. Take page number 6.16 and take illustration. Okay. Please read the question. Okay, so what's given in the question? DBA manufactures and sells 25,000 table fans annually. So what's the name of the company? The name of the company is DBA. DBA. What does this company do? It manufacture and sell table fans. Okay, now how many table fans? 25,000 table fans. 25,000 table fans per annum. Going ahead, one of the components required for the fans is purchased from an outside supplier at a price of rupees 190 per unit. Okay, component purchased. Component purchased from outside supplier at 190 per unit. Okay, annually it is purchasing 25,000 components for its usage. So it requires 25,000 components. Why 25,000 components? Because the input output ratio may be, output is 25,000 numbers table fans and input is 25. So input output ratio is 1:1. Okay, now what's happening? The production manager is the opinion that if all the components are produced at on plant, it is possible to maintain better quality in the finished product. Further, he proposed that the in-house production of the component with other items will provide more flexibility to increase the annual production by another 5,000 units. So production manager says, production manager is against purchasing the component from outside. He says that we can also manufacture this particular product in-house. So there are two advantages. One is better quality finished products, better quality finished goods, that is one. And second one will be possibility to increase production to 30,000 units. Okay, so increase by 5,000. Now he estimates the cost of making the component will be as under: materials 80, direct labor 75, factory overhead 70% variable 40, and total cost will be 195. The proposal of the production manager was referred to the marketing manager for his remarks. He pointed out that to market the additional goods, the overall unit price should be reduced by 5%, and additionally 1 lakh rupees per month should be incurred for advertising. Present selling price and contribution per fan are 2,500 and Rs 600 respectively. No other increase or decrease in all other expenses as a result of this proposal will arise. Required. Since the making cost of component is more than the buying cost, the management asks you to analyze the make or buy decision on unit basis and total basis. Recommend the most profitable alternative. Okay, so that is the question here. Now what do you have to do? Okay, okay, now the company has given the cost of manufacture and cost of purchase of the component. So first we will have to compare the cost of manufacture with the cost of purchase of the component. What is the purchase cost? Of the component is equal to rupees 190 per unit. Okay, now cost of manufacture option. manufacturing the component. Okay, what's the cost of manufacturing the component? Direct materials rupees 80 per unit. Okay, then direct labor rupees 75 per unit. Okay, then variable overhead. Variable overhead is how much? 70% of rupees 40. 28 per unit. So total variable cost per unit will be, it is 3 times 183 per unit. Okay, so the purchase cost is 190 per unit, whereas the cost of manufacturing is 183. Now what do you have to do? You have to do a analysis. Okay, analysis of the proposal. Okay, additional I will make it as analysis of the proposal. What is the proposal? Manufacture proposal. Okay, they say that there are two things that is happening on this proposal. One is cost of the component reduces. Okay, then second thing, production capacity increases by 5,000 units. Okay, so we will have to first find out what would be the savings on account of manufacture. Savings on account of manufacture. What would be the savings? Savings in variable cost per unit. How much variable cost per unit is? Presently it is, that is equal to purchase price per unit minus variable cost of manufacture per unit. Okay, that is equal to rupees 190 minus, what is the variable cost of manufacture? 183 rupees 183 per unit, that is equal to rupees 7 per unit. Okay, now total savings on variable cost. On what quantity? On the present existing quantity. So on 25,000 units. Okay, so 25,000 units into rupees 7. That will be 25,000 into 7, 1,75,000. Is it clear? That is one thing. Now second option is there is increase in the production capacity. Increase in the production capacity. With the increase in the production capacity, what is happening here is increase in sales volume. Okay, this impact has to be analyzed. What do they say? They say that in order to the marketing manager pointed out that to market the additional units, the overall unit price should be reduced by 5%, and additionally 1 lakh PM should be incurred for advertising. Present selling price and contribution per fan is 2,500 and 600 respectively. Okay, so first what you have to do, number of additional units sold, 5,000 units. Okay, this let me, okay, reduction in revised selling price per unit. Presently it is 2,500. It has to be reduced by 5%. Okay, now contribution. What will be the contribution? Additional units sold. Present contribution per unit will be how much? They say that it is 600. Okay, there is some changes happening to contribution. Add the variable cost is decreasing by 7 rupee, because if you are manufacturing, the variable cost of manufacture will be only 183 as against 190. So naturally what will happen, 7 rupee will increase in terms of the contribution. So add increase in contribution per unit due to fall in purchase cost, that is 7. Now what will happen next? The selling price is coming down. So when the selling price comes down, contribution will also come down. Okay, so decrease in selling price per unit, that is 2,500 has become 2,375. $125 per unit. Okay, so revised contribution per unit will be 600 plus 7 minus 125, that is 482. Okay, therefore additional total contribution from the 5,000 additional units, it will be 5,000 into 482 into 5,000, that will give you 24 lakh 10,000. Okay, 24 lakh 10,000. Is it clear? This is additional. So this is 2. Now there is one problem. What is the problem? When the selling price is reduced, the selling price will reduce not only for this additional 5,000, it will reduce for all the units. So that is a loss of contribution, loss of existing contribution, which is an outflow. Okay, so reduction in selling price per unit is equal to 125. Therefore, fall in contribution on the existing goods (125 into 25,000), that is 31,25,000, and this has to be what? Negative. Is it clear? So what's happening here is, and also there is additional advertisement expenses. That is 1 lakh per month into 2, that is rupees 12 lakh. This is 4. So net cost, net savings or cost due to manufacture. Okay, how do you do that? First one was savings on account of variable cost, 1,75,000. On account of manufacture, that is 1,75,000. Then add additional contribution from 5,000 units. What is the additional contribution from 5,000 units? We had computed it is 24 lakh 10,000. 24 lakh okay. Then less what? Less fall in contribution, of existing products due to decrease in selling price. It is negative 31,25,000. Then less increase in advertisement cost. Okay, 12 lakh. Therefore, net savings of cost due to manufacture, that is equal to 1,75,000 plus 24 lakh 10,000 minus 31 lakh 25,000 minus 12 lakhs, that is 17 lakh 40,000 minus 17 lakh 40,000. Okay, so what does it mean by manufacturing by manufacturing the component in-house, the entity will incur an incremental loss of rupees 17 lakh 40,000. Therefore, the option to manufacture the component is not financially feasible. That is the prima facie observation. Now, is it over with this? Now, what is the question? The question, they say that recommend the most profitable alternative. Okay, so on this most profitable alternative, from financial perspective, it is better to outsource, but you will have to analyze it further. Okay, if you see what is happening here, there are two things happening. Okay, one is manufacturing component in-house. Okay, that is one. Second is manufacturing and selling 5,000 additional units. Okay, let us take this as A and this as B. If you see the areas where the cost of revenue differs, savings on account of manufacture, this is purely something due to A. Okay, that means what is A? A is manufacturing the component in-house. Okay, this savings is purely due to manufacturing of the component in-house. Now, additional contribution from 5,000, 24,000, this is purely due to B, because we are deciding to manufacture additional 5,000 units and sell that. This is fall in contribution existing products due to decrease in selling price. Why do you have to decrease the selling price? You need to decrease the selling price only to sell 5,000 additional units. Am I right? So this is also purely due to B. Now, what about this increase in advertisement cost? The advertisement cost is required only if you are planning to sell additional 5,000 units. Okay, so this is also due to C. Now, if you see these three together, it will be 24 lakh 10,000 minus 31 lakh 25 minus 12 lakhs. It will comes to 19.15 lakhs. Okay, which is a additional cost. 19.15 lakhs loss. Okay, so the second option, that is producing 5,000 units more, is a financially non-viable option because it is resulting in an incremental loss of 19.15 lakhs. Whereas the first option, that is to manufacture the component internally, 25,000 units of components internally alone gives you a savings on account of manufacturers to the extent of 1,75,000 rupees. So naturally the question will be, why can't you suggest to manufacture the component internally without manufacturing 5,000 units additionally? So if you are manufacturing the 25,000 components internally, then you can have a cost saving to the extent of 1,75,000. At the same time, you don't have to bother about the loss which you are generating on account of the additional production of the additional production of 5,000 units. So the recommended option should be not to produce the additional 5,000, but to manufacture the components internally for 25,000 units. Okay, so you can write the recommendation. It may be seen that the proposal evaluated evaluated results in a loss of 17,40,000. How much is 17,40,000? 17,40,000. Okay. However, the said proposal, consists of two options, which are independent to each other. One, manufacture 25,000 units of components, 25,000 units of components in-house. Okay. This option will result in an increased quality of the finished goods. Also, this option yields an additional profit of additional cost saving of rupees 1,95,000, rupees 1,75,000, 1,75,000. Thus, this option independently is financially and otherwise viable. Okay. Now, what is the second option? Second option is manufacture additional 5,000 units of components. What's happening here? Here, this option will result in increasing the total production to 30,000. However, in order to sell these additional units, the entity shall incur additional cost for advertisement and reduce the selling price. The cumulative impact of this proposal results in an incremental loss of, what is the incremental loss? Incremental loss of 19,15,000. Therefore, this proposal should not be implemented, as both these options alternatives can be implemented without affecting the other. We are of the opinion that the entity shall implement option 1. Is it option 1? Option 1 alone. Option 1 alone. Is it clear? Okay, so though they are giving you two options together, on an analysis it comes that it is better to go with the option 1 alone rather than going with both the options together. So that should be implemented. Okay. So that is over. Recommendation is over. Now next heading, sell or further process. Sell or further process. Okay, now what are these the situations, decision making situations? Suppose there is a company A Limited. A Limited is manufacturing a product A using materials X, Y and Z. X, Y and Z were added plus necessary labor plus overheads. Okay, you are getting A. This is the final product. But along with A, there is another product called B, which is a byproduct. This is a final product, but B is byproduct. Byproduct of what? Byproduct of this manufacturer. Okay, now going further, A can be sold in the external market. Okay, sold in the external market and realize the proceeds. So there is no confusion with respect to A. Now the problem with B is a byproduct which does not have any no marketable value at this stage. Okay, because this is only the point of separation. So it just byproduct has come out. As such, it doesn't have any value at this stage. So now what you have to do? If you do some further processing, the value of the byproduct may increase. So this decision making whether or not to further process B is referred as what? Is referred as sell or further decision making. Okay, so what you have to do here, you have to see what is the cost of further manufacture, further processing, and it should be compared with the sale proceeds that it is likely to fetch. Okay, and compare these two and take a decision on that. Okay, now here what I told you was product B has no marketable value. Now sometimes what may happen, at this stage itself it may have marketable value. That situation may also come. In that case, what you will have to do, you will have to compare the marketable value here, okay, and the marketable value after value addition, further value addition. Compare these two and see what is the incremental increase in incremental revenue that the entity is fetching on account of further processing. That should be compared with what? The cost of further processing. Okay, so analysis. Analysis. Okay, then there could be two situations. Okay, product has marketable value as such, it has only marketable value only if it is further processed. Only if it is further processed. Okay, now in this case, what you have to do? Okay, compare Okay, so you are comparing the marketable value without processing with marketable value of the output after processing. So this is nothing but the incremental sales value. Now this incremental sales value should be compared with, so this is one, okay, it should be compared with compute. What should be computed? Okay, the cost of further processing. Okay, cost of further processing. If there could be two situations, if incremental sales value is higher than cost of further processing, what you have to do? You have to further process. If it is reverse, incremental sales value is less than cost of further processing, then the decision will be do not process further. Do not process further. Okay, if the incremental sales value is 1 lakh and the cost of further process is 80,000, so you are getting an incremental benefit of 20,000, so do the further process. If the incremental sales value is less than the cost of further process is 1 lakh, but incremental sales value is only 80,000, so 20,000 net loss. So what should be the conclusion? Do not process further. Okay, this is when there is a marketable value. Now here, if there is no market value at the time of without any further process, then what do you have to do? Compare the incremental sales revenue. What is this incremental sales revenue? This is the marketable value of the product after processing. This should be compared with the cost of further processing. Okay, here again, this is the thing. Incremental sales revenue is greater than the cost of further processing. Go for further processing. Otherwise, no further processing. Is it clear? This is how you take a decision with respect to sell or further process. I hope you all have written this, right? Okay. Okay, now some specific points which you need to keep in mind is 1. Okay, only the incremental cost of further manufacture should be considered. Any cost incurred up to this point, that is before commencing the further process, the further manufacture, is not relevant for decision making. Okay, that means okay. Okay. Suppose any cost incurred by the incurred for that particular product before the point of decision of further manufacture is not relevant, because that cost will be incurred irrespective of whether you opt for further manufacture or not. Okay, so for example, there is one product A for which we are considering the option of further manufacture to convert it into a value added product of A plus. Okay, further manufacture. So any cost incurred by A up to this point where the further manufacture starts, okay, it is not a cost up to this point, is not relevant, because what we are evaluating here is what? The decision with respect to further processing or not. Am I right? So when you take such a decision for further process, only the costs that you are proposing to incur from the point of commencement of the further manufacture will be a relevant cost. Any other cost you will have to even otherwise incur. Okay, so not relevant. Now this will be even more relevant in case of joint products. Okay. You can write in case of joint products, any cost up to the point of separation is not relevant for deciding whether or not one of the joint product should be, whether or not one joint product be processed further. Okay, what does it mean? Suppose AB Limited is doing certain activity and certain manufacturing. Due to result, you are getting two products, product A and product B. This is main product sold at rupees 100 per unit. Now, as far as B is concerned, no market value at this point, but can be processed further. Okay, so when you take a decision with respect to the further processing or manufacturing of this joint product B, any cost incurred up to this point of separation, let us say for this they have taken up to 5 lakh rupees. Okay, any cost up to this 5 lakh is not relevant, because anyway this joint product, this manufacturing process have to be undertaken irrespective of whether B is manufactured or not, B is further processed or not. Why? Because you need product A. If product A is should get, then you should exercise this, you should incur all these costs. So this cost will be incurred irrespective of whether you are deciding to process product B further or not. Clear? Okay. So you have to consider some qualitative factors also. What all things will be the qualitative factors? Qualitative factors to be considered. Okay. 1. Resource availability for further manufacturer. Okay. This resource could be material, or it could be labor or machine, etc. Then if over time or double shift is required, then what do you have to see? Impact on the quality of the products, because the same employees are going to do overtime, their efficiency and due to which effectiveness will come down, so the quality may be affected. Okay, then next you have to see availability of market or demand for the product, for the original product. In bracket you can write that is without further processing. Without further processing. Okay, so these are the few factors to be considered, qualitative factors to be considered. Okay, now I think you will have to move with do a problem in study material. You can take question number, yeah, page number 6.19. There is an example given. We'll take that. Okay, this is an illustration, an example. So both question as well as answers are given together. So I will just read it. Okay, a process industry unit manufactures 3 joint products A, B and C. C has no realizable value unless it undergoes further processing after the point of separation. The cost details of C are as follows. Up to the point of separation, there is marginal costing 20, then fixed cost 20. After the point of separation, it is 15, 5 and 70. C can be sold at 37 per unit and no more. Cost incurred on product C up. Okay, so this is the question. Okay, now what is given in the answer? Or I will explain the question first. Okay, there are 3 products which are joint products. So you have joint products, product A, product B and product C. And there is no much information about product A and B. So you can assume that product A and B both are marketable and they will be marketed in the normal course. But as far as product C is concerned, no, it doesn't have any realizable value. No realizable value unless it is processed further. It is processed further. Okay, so the cost details are given. Cost details of C are given. There are 2 types of cost. Cost incurred up to the point of separation. Okay, they say that both variable cost per unit. What is variable cost per unit here? 30. Or fixed cost per unit. This is allocated. How much it will be? 20 per unit. Okay, now cost after the point of separation. After the point of separation. Okay, now why it is this cost is incurred? It is incurred for further processing. Okay. Now what can you do? Here also there are two types of cost. One is variable cost of further process, and this is fixed cost, maybe apportioned. Okay, what do you say here? The variable cost is given to be 15 and 5, and is 5. This is relevant and this is not relevant because this is only a portion of fixed cost. This is not relevant. Here it is, this is relevant because it is to be incurred if you want to do the further processing. Okay, now let's see what is given in the question. C, cost incurred on product C up to the point of separation is irrelevant. We have already seen that. For decision making, as product C is a joint product. Joint products are the results of same raw material and same process and operations. We know that, right? Okay. Done. The cost incurred after the point of separation will be considered for decision making as specifically incurred for product C. After further processing of C will contribute 17 per unit towards the joint production cost. Why 17? Calculation is as follows. What is this? They say that C can be sold at 37 per unit. Okay. Now, selling price of product C. Okay. This is rupees 37. Okay. Then less cost up to separation. You can write not relevant. Okay, so nil. Less cost after separation for further processing. Okay, now what's happening here is, here you have two types of cost. One is marginal cost of further processing or manufacture. Okay, this is given to be rupees 15 per unit. Then you have fixed cost per unit. Now friends, here you have to be a bit careful. Okay, this fixed cost per unit, what is this fixed cost per unit? This fixed cost per unit is nothing but the apportioned portion of the general fixed cost of the entity. Is there any mention that this fixed cost, we are talking about, is a specific fixed cost? No, nowhere they are saying that it is a specific fixed cost. Okay, so we have to assume that in the absence of information, it has to be assumed that it is a apportioned fixed cost, hence it is not relevant. Okay, not relevant. Okay, you can write a note this here. It is assumed that the fixed cost per unit rupees 5 incurred after the point of separation for further manufacture for the manufacturer is only an apportioned portion of general fixed cost. Hence, it is not relevant. Okay, you can also write alternate assumptions do exist. Okay, so see, if you see the textbook, it is altogether different assumption. Here they have considered this fixed cost per unit as a relevant cost, but as a general principle we have to say, if nothing is specified, any fixed cost has to be taken as an apportioned fixed cost which does not vary with respect to the decision taken. Therefore it has to be considered as an irrelevant cost. Okay, so what will happen? Net contribution per unit, how much? Rupees 37 minus 15, that is 22 per unit. Is it clear? So you can conclude further manufacturing of the product of C will yield an additional contribution of rupees 22 per unit. Therefore, it is viable to process the product further. Okay, right. Now that's all with this question. Okay, so you will have to move forward to the next. You can write the heading minimum pricing decisions.